Hi everyone, and welcome to the Buffett and Beyond weekly video stock analysis. And this methodology is based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And that's exactly what we've been doing for the past 22 years. And remember what our goal is, folks. Our goal is to build your wealth faster and safer with better than average stocks. But how do you tell which stock is better than an average stock? Just because it outperforms the market averages for a while? We want to see nice, consistently faster growing stocks in our portfolio. That's how you construct a portfolio. So let's get right to it. And today we're going over a stock that's in the computer peripherals business or industry, and that is our friend Apple Computer. And what does Apple Computer do? Well, folks, all you got to know is it makes a smartphone, and everybody wants a smartphone. In fact, I just heard one analyst say you would rather sell your second car in your family than give up your iPhone, and that's it. So this is what Apple does, folks. It does an awful lot of things, including the iPod digital music player, and of course the smartphone, which we just mentioned, the Apple Watch, and it also sells operating system services like iCloud storage and Apple Pay. And folks, these are coming on strong, the iCloud storage and the Apple Pay. So we're going to see that all over the place. You've got an Apple phone, you might as well pay your bills instead of taking a credit card out of your pocket, or instead of even carrying a credit card. So let's look at the Apple compared to the market averages. In other words, is this stock a better than average stock? Well, we're pretty sure it is because everybody's got Apple. But do the numbers agree with everybody's thinking? And the blue lines here are the market averages, or I should say the average stock in our 1800 stock database. So the clean surplus return on equity, and we're going to see that in the next slide. Clean surplus return on equity. Think of your bank account. If you had the choice to invest in a bank that was giving you a return of 13.5% and the bank down the street was giving you a return of 23.5%, which bank would you go to? Yeah, exactly. And what the clean surplus means is that we develop the numbers, or we reduce down the numbers of book value and the earnings, and we use clean surplus earnings, and we reduce them down so we can compare one company to another. In this case, we're comparing Apple to the rest of the market averages. So the average clean surplus return on equity, think of your bank, is about 13.5% right now over the past 5 years. For Apple, 23.5%. Right here, this is a better number. And folks, my doctoral dissertation was on the research. Do stocks with higher clean surplus return on equity actually outperform stocks with lower clean surplus return on equity? And again, think of your bank account, because that brings us down to common sense. And yeah, Apple is doing just that, almost doubling the average stock out there. Now, when it comes to net income, what is net income? Net income is the clean surplus earnings. When you take traditional accounting earnings, you subtract the non-recurring items, the things that are not involved with the true operations of the company, take them away, take away future liabilities and a few other things, and that gives us a comparable earnings number, which is called net income in the clean surplus world. So the average stock, about a 13% net income. Notice how the net income or the earnings compare with the return on equity, the clean surplus return on equity. Yeah, you want to see that. When this starts going down, when the net income number starts going down, that means your clean surplus ROE is going to start going down either this year or next year or the year after. Okay, back to Apple. Apple is in green, of course, and we are looking at their net income of 19.1%. And so we can see that the net income is correlated with the return on equity. Higher net income growth, and this is the 5-year average net income growth, correlates highly with the clean surplus return on equity. So that's what we want to see. Now, to get good earnings, you have to have revenue. You have to have a lot of revenue and operate efficiently. So the average stock out there in investment land, or at least in our database, has a revenue growth of 7.1%. And Apple is double that, a little bit more than double that. So when you look at Apple and you look at the average stock out there, or the average stock in our database, you could see Apple is higher in every aspect than the average stock. So therefore, the numbers are telling us Apple is a better than average stock. Now let's look at a few other metrics. And here's that clean surplus ROE. So in other words, we are looking at 2023, the remainder of 2023, and projected for 2024. And we can see that clean surplus return on equity. I like to look at the 3-year average and the 5-year average of the clean surplus return on equity. Again, when you think of return on equity, think of your bank account. You want to put your money in a bank account that's paying a higher interest rate. And that's the same way that we can look at stocks when we configure their numbers by clean surplus. Clean means cleaning up the earnings. Surplus means earnings, positive earnings. So when you see the 5-year and the 3-year average very, very close, that means this stock is growing very, very consistently. Now, let's look at the retention rate. What's the retention rate? Retention rate is the amount of money the company is making and puts back into itself. So it's averaging about 82.5% over 5 years, which means it's paying some of the money it's making out in the form of a dividend. We look over here, it's a very, very small dividend. Because when you're constructing a growth portfolio, you don't want to see them pay out a lot of dividends, folks. You want to see the company put money back into itself in order to grow. And we are looking for growth stocks. That's how we build our wealth into our future so we can retire and go to lunch, go to dinner, and have a good retirement because we don't have to worry about money. You want stocks that are growing, and that's what the retention rate is telling us, that this stock is growing. And is Apple seeing growth ahead? And the answer is yes, because the clean surplus return on equity is above that 13% of the average stock. So therefore, Apple continues to see growth out there, and the retention rate means it's putting money back into itself in order to grow. Now here's the net income growth over 5 years and the revenue growth over 5 years, which we showed on the chart. Nice numbers, folks, way above average. Years to pay debt. This is Buffett's rule of thumb. And what Buffett says, if a company takes all the money it's making and puts it back into itself in order to pay off the debt, how many years will it take to pay off the debt? He wants 5 years or less. We want 3 years or less. Apple, if it has to pay off its debt, could do it in 1 year with its earnings. So in other words, if interest rates go up, we don't have to worry about Apple having to struggle to pay the increased interest on its debt. So these numbers look very, very good. Let's get back to the chart form. Yeah, this is easier to look at, isn't it? But I just wanted to bring those other metrics in. So again, we're looking at a stock, Apple in green, with higher everything than the average stock in our database. And our database includes the Dow, the S&P 500, and a good part of the NASDAQ stocks, the larger NASDAQ stocks. Okay, but we have to look at one more thing, folks. Does the market like it? In other words, do the market participants, do you and I like this stock, and are we buying it more than the average stock? Now here, the black line is the S&P 500. So the golden rule out there is to be able to outperform the S&P 500, because over any 10-year period, rolling period, 96% of professional money managers, and those are the folks who run the publicly traded mutual funds, 96% of them cannot outperform this black line here. So over the past 12 months, has Apple outperformed the S&P 500? Well, with the S&P 500 about 3%. We are looking at Apple returning as of the last day of May, which I'm recording this. It is up 20% with the market up about 3%. So yeah, it's certainly outperforming in the last 12 months. But how's it do over the long term? Well, over the long term, black line S&P 500 up about 50%. And folks, that's average. You want to look at the S&P, and it returns a little 10%, maybe 11% per year on average. What is Apple returning over the past 5 years? Well, about 275%. So we are looking at over 5 times the return of the average stock. And remember, 96% of the professional money managers out there cannot outperform the average stock out there. And I just want to say this one thing. When we were doing our radio show, we would say, send us your portfolios. We'll tell you how you're doing. And I tell you what, almost everybody had about half their portfolio in good stocks that we would recommend, or we would at least say, don't sell that stock. It's a better than average stock. But they also had half their portfolio in stocks that were below average. And folks, some big names that we've lived with all our lives are not above average stocks. And boy, I tell you, it was absolutely amazing about how many people, which was most of them, had 50% of good stocks and 50% of below average stocks, and that means that their portfolios were underperforming the S&P 500. So folks, remember, what's our goal? Our goal is to build your wealth faster and safer with better than average stocks. That's how you do it. And how do you know which stocks are better or which are not? Well, you can go to our site, BuffettandBeyond.com. Buffett and Beyond is all one word, BuffettandBeyond.com, and sign up for a 2-week free subscription. Folks, you have nothing to lose. Sign up for it. We'll send you everything, and you can take a look at our computer program, because it's hard to figure out those numbers in a clean surplus condition. It takes work to do that. We have the numbers there for you, folks, and it's free for you. 2 weeks of free subscription. Remember our goal, build your wealth faster. You want to build your wealth faster and safer. You want to fill your portfolio with stocks that are better than average stocks, and you will do fine over time. So folks, remember, if you want to live on a beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett.